Hey guys, welcome back to the Capital Mindset Show. I want to welcome you to another reaction video. This time we're going to be doing one on a much larger organization, so to speak. It's actually CNBC. So the title of this video is probably quite telling. Call it reliable sources. This video was actually requested to me by a friend of mine who actually works in corporate taxes. So it's going to be quite interesting video. They told me a little bit about the video already, saying that, you know, they make some interesting statements, and apparently, supposedly, that there's like a cop-out in the beginning of the video that kind of excuses everything else that they say throughout the rest of the video. During the video, I'll be sipping my coffee here because I'm drinking my coffee right before starting work, making this video, this fun video. We'll see how much, if it's really cringe, if it's not that cringe, we'll see. And then towards the end of this video, I will actually be sharing some interesting tidbits about you know, maybe some research that you guys could actually expand upon in your own time for fun. And it's kind of an exploration of a phenomenon. And also, I want to state that if you guys haven't known, I actually had a live stream yesterday, and please join the live streams. They're very interesting in terms of your ability to ask questions and me to answer live. I know that the time constraint, so I do apologize for that, because I know the Capital Mindset, at least based off of the analytics, is a very global audience, and I'm very proud of that. So we have people, it's quite literally, I think, like less than 50% are American, and then the rest are actually global. But on that note, I actually want to say that if you guys want to, there's a free Discord community you can join now. It's for everyone to kind of just gather together, talk about things, you know, and there's going to be a lot of different chat rooms available there, whether or not, you know, you want to talk about different kinds of things. So yeah, check that out if you guys are interested. If you're not, don't worry about it. I have no hard feelings. Just enjoy the video here. So on that note, we're going to begin, and I'll actually take us right here and we'll get started. All right, so let's press play.
The current United States tax code allows some of the most profitable companies in the world to not pay any federal corporate income taxes.
The present tax system ain't fair.
Actually, at least 55 of the largest corporations in America paid no federal corporate income taxes on their 2020 profits.
And paid zero in federal taxes.
Some of these companies include big names like FedEx, Nike, HP, and Salesforce. These companies are not doing anything illegal, and these companies pay many other forms of taxes.
That's the cop-out, I believe. Yeah, so they're gonna discuss the rest of this video and focus in on one particular form of taxation, but that sentence right there definitely would void any criticism, because I think I know where they're going, because it's a fairly common argument that they're about to make. So I can kind of more or less gather what this video is about. But this video made by CNBC is targeted towards a wider audience. So definitely not, you know, tax professionals or anything like that. But yes, the form of taxation that they're going to focus on is federal tax, federal income tax in particular, that specific tax. Just by saying that, they're going to shield themselves of all criticisms technically, because, you know, in the very beginning of this video, they left that cop out. They left that door open by saying, well, they pay all these other forms of taxation, so it's not that they don't pay any taxes, and it's not that the federal government gets its worth out of it. But we'll discuss that a little bit further in greater detail.
If a large, very profitable company isn't paying the federal income tax. Okay,
so this is important because, you know, they bring these guys up in CNBC a lot. So, you know, argument from authority. So this guy's right because he is a senior fellow at the Institute on Taxation and Economic Policy. All right, so he's completely right. We shouldn't question anything he says.
Then we have a real fairness problem on our hands.
And it's costing the government billions.
You can think about a bucket of...
I guarantee you, when they say it costs the government billions, they're going to cite the government or institutions that are close to the government. And a quick rule of thumb, typically, almost every single time, actually, the federal government or institutions around the federal government, what they'll do is their estimates are always overestimating the amount of revenue they'll collect and underestimating the costs of any project that they propose. Typical rule of thumb. All right, so just before we continue.
Corporate tax breaks that are deliberately there in the tax code, and overall they cost the federal government roughly $180 billion each year. And for comparison, the corporate tax brings in about $370 billion.
All right, so Joint Committee on Taxation, this is exactly kind of what I was talking about. So corporate income tax brings in, okay, so they overestimate how much it brings in probably, and underestimating the cost associated with procuring those funds. But we'll get, again, towards the end of this video, I think it's quite important to discuss this phenomena that actually shows that none of this really actually matters. But
Of revenue a year.
Those 55 corporations would have paid a collective total of $8.5 billion. Instead, they actually received $3.5 billion in tax rebates.
Corporations can receive refunds just like individuals do.
And that doesn't include corporations that paid only some of these taxes, but not all.
The federal government estimates that there's about $40 billion each year in corporate taxes that are clearly owed.
Here's how the most profitable companies in the country avoid federal corporate income taxes. It's important to note the federal income tax is not the only tax corporations pay. They're subject to state and local taxes too. Right now, we're only talking about the corporate federal income tax rate, both domestic and international.
Federal tax rate at the moment is 21% for domestic profits, but it's as low as between 0 and 10.5% if those profits are profits of a US multinational that are earned offshore.
What do we do to make America the most competitive place in the world?
The 2017 Tax Cuts and Jobs Act slashed the 35% corporate tax rate to that 21%.
It's the only tax levied at any level that publicly traded businesses are supposed to pay in proportion to how well they're doing. Where the bigger you are, the more successful you are, the more you ought to be paying.
The corporate federal income tax, it's about 7% of all revenues that the federal government collects.
Let's look at Amazon as an example.
Alexa, how much tax should Amazon pay?
Sorry, I don't know that one.
see, but you see, like, then you're changing the argument and kind of trying to make it appear as though Amazon does not pay any tax. And, you know, proportionate to their size, they probably pay an absolute disgusting amount of taxes. So taxation is collected in a variety of forms. By focusing simply on the federal income tax, you're kind of ignoring. But again, they have left the door open. And I'm highlighting to you, the viewer, that they did that on purpose, okay? Because the rest of this argument is just surface level. And by stating that in the beginning, if, for example, I were to have a discussion with any of these individuals shown in this video, they will probably state to me, well, we said that in the beginning of this video. And then I will say, well, then you're just probably being a little bit misleading, because the average person is, or, you know, people who are not well versed in finance or accounting are not going to remember that or take that sentence that you said at the beginning as kind of like a greater understanding as to the contents of the rest of this video. So this rest of this video is making arguments on the federal portion of taxation, but then using language like we just stated, like that woman who just showed up, how much taxes, she didn't say how much federal income taxes, and I doubt that she said that question with the understanding that federal income taxes is one form of taxation. No, she stated it as just broad-based taxes. How much should Amazon pay? And in reality, if we take a look at the amount of taxes Amazon pays, it's a hefty amount. And there's a reason why the tax code is structured the way it is. And it's a credit to, you know, well, it's kind of like saying we want the same people who created these so-called problems to fix these so-called problems in complete trust that they won't create more further so-called problems, which is kind of an interesting presumption in and of itself, because the only reason why, and I'm trying to give them like a little bit of a break here in saying that they structured it in a somewhat intelligent way, because the tax breaks or the tax incentives built into the system are supposed to drive specific key behaviors that, you know, are at the end more beneficial to the actual end recipient of taxation, which is the federal government. Which, as we'll see at the end of this video, there's one key factor that is a far greater effect or a factor in terms of how much tax receipts the federal government will actually collect.
Amazon became famous in 2018 when the company reported about $11 billion in U.S. income and paid zero federal income tax. They actually got a tax rebate of $129 million according to their financial reports. We now have 4 years of data. In those 4 years, Amazon has now reported 79 billion almost of U.S. income and has paid a total of 4 billion in federal income tax for.
Okay, one thing you're ignoring. I hope they go into difference between book income and tax income. They better go into that, because then that's extremely misleading. But I'll wait for them to give them the chance. But right here, the problem with what they're saying is they're definitely, and I probably don't think they're going to get into this because this would destroy their current argument, is that you're allowed to carry forward losses, right? So when you have a loss and you can accumulate these losses actually accumulate as a tax asset in your balance sheet, because you can carry forward these losses into the future and then put them against future gains. There has been limitations put onto this, actually from the same bill that they're criticizing right now. The same bill that they're criticizing actually put forward limitations, because there once upon a time, there actually weren't any limitations on carrying forward losses. Or if there were any limitations, they were quite small. Tax accountants love it when the tax code changes that much, because it completely, I'm being obviously sarcastic. They hate it when it changes that much, because those drastic changes, they basically have to relearn a lot of things. But and if you don't believe me, just go ask anyone who works in taxation how they felt when the Tax Cuts and Jobs Act was implemented, that it wasn't just simply a reduction in corporate taxes to 21%. There was a whole host of limitations on certain deductions and stuff like that. For example, there's a limitation on deductions for meals. Like, you used to be able to go out and buy food and go out and do these meals, and the Tax Cuts and Jobs Act limited it to 50% of the expense can be a deduction. I'm not sure if the Biden administration, because I know he wanted to raise it back to 100%, not conveniently, but like interestingly, that you could throw these conventions now and you could deduct 100%. So you're more incentivized actually to throw, conventions, parties and stuff like that. Whereas before, under the Tax Cuts and Jobs Act, it limited it to 50%. But then before that, it was again at 100%. So again, why would you want to incentivize these? And I'm not saying it's a bad thing. You want to incentivize it because, remember, your expense is someone else's income. So if a corporation throws an event and they're spending all this money and they can deduct it all, well, they're incentivized to do that, right? They don't want to go out of their way to just throw away all their money. No. But if they want to throw an event, they can be like, oh, it can be a write-off. It's fine. It's not a total loss. There is an actual added value back to it in some capacity. And that expenditure is maybe that hotel's income. That hotel has employees, and then now they get a more secured income. Maybe that's the staff there, the waiters, the servers. They're going to get tips, from the company, and that also is their income. So all these trickling effects, and then all those people, in essence, they will be taxed, right? So the government still gets its taxation, which is again, why I'm highlighting that this is a very surface level argument. The government benefits from that movement of money. While they may not get taxed on that particular expenditure from the company, right? In that particular case where that's a deduction, that expenditure itself will then therefore be taxed as it trickles through. And then that's to still the benefit of the federal government, which is why they end up liking to do this. And that's what it's supposed to be designed to do.
A 4-year tax rate of 5.1%. So what that means is that they're avoiding.
Again, he's ignoring that you can carry forward losses, completely ignoring that. That's misleading.
Income tax at the federal level.
Remember that the federal rate is 21%. So in 4 years, Amazon's effective tax rate was 5.1%.
Again, conveniently leaving out that you can carry forward losses.
I'll emphasize that everything I've just said about what Amazon is doing appears to be completely legal.
Amazon told CNBC.
You're not going into it, and that confuses people. Do you not understand how that can confuse someone? You're showing a number. You're saying it should be 21%, and then you show 5.1%. No explanation of how. So obviously, the intent of that segment, of that piece of the video, is supposed to get the average person to get riled up and emotional, which is, again, I guess that's how you make money, CNBC. You get people emotional and they watch your videos. And I know if we go through the comments, you can see that people are, thinking emotionally about this, but, they're seeing 5.1, then they see 21%, and they see a difference, right? 21% is not 5.1%. There's a mismatch. You don't explain it. You don't say why. You don't explain how the rules are there, and actually how they're just carrying forward losses from previous years, right? And then it does make sense to do that, because then you incentivize years in which companies need to make heavy investments and perhaps need to lose money, right? Otherwise, you don't incentivize that investment period, right? What would happen if we say you can't carry forward any losses, right? Then companies are going to be less likely to want to invest in periods where they probably should. And then therefore you would probably end up as a result in aggregate with less large companies, right? Or less influential companies in terms of a global marketplace. And the consumer at the end of the day probably is going to not stand to benefit from convenience, from innovation, right? So that incentivizes a ton of innovation, but regardless.
We see that its U.S. taxes reflect its investments, employee compensation, and current
Well, of course,
tax
Amazon's
laws.
going to say that,
The
but
company paid
you're
federal
saying
income taxes, other federal taxes, and state and local taxes. Publicly traded corporations have two different ways of accounting.
Oh, here they're
So
going
one
into it.
form of
There we go.
accounting is for shareholders. Let's call it book income.
You
Oh,
have
it is
profits
called
that are
book
reported
income.
to shareholders using general accepted accounting principles under financial accounting. And the purpose of that is really to determine, is this corporation profitable? Is it worth investing from a shareholder perspective? How is the firm doing from a performance side of things?
And the second form of
surface
accounting is
level
for
explanation.
taxes. Let's call it taxable income.
That's
You have
kind of
a set
also
of
what it's
rules
called.
that are different from and often diverge from that accounting. Determine how much tax a corporation is paying. And what that means is the amount of profits that corporations may be reporting for financial purposes may be very different from the profits that they are reporting and they're paying taxes on for tax purposes.
This is how some companies are able to tell investors we made billions of dollars, but turn around and tell the government we made $0. We can call all of these tools a form of tax expenditures. Tax expenditures are any targeted tax break. Think tax credits or incentives.
We want more oil. We want more solar energy.
Are they literally going to argue that you shouldn't give breaks to expenses? I mean, that would be a very interesting argument. Very interesting if they try to make that. But yes, there are two forms of two forms of accounting: tax accounting and book accounting, or GAAP accounting. GAAP accounting is supposed to be kind of a look into how a company is doing. And you can change GAAP with IFRS. So IFRS, international standards, and then GAAP is United States standards for those of you who are international. Like I said at the beginning of this video, a lot of capital mindset viewers are international. So GAAP accounting for the American audience and also for the international audience, again, is just the United States form of standards. And it's supposed to be for, again, seeing how a company's doing. They're right on that. Tax accounting is dictated by the United States federal government, right? The federal government says how, tax accounting can be done. So they set the rules on that front. And I guess that's why they're arguing that the rules should be, quote unquote, changed here. Now, the problem with what I'm seeing so far is that they're kind of making a stance or an argument towards limiting expenditure, which I've just discussed as why the federal government actually wants that expenditure to kind of go forward, or more expenditure is better in a sense. You want investment. Investment is someone else's income. That someone else's income is more, it provides a trickling effect throughout the economy. And as long as the money is moving and flowing and that GDP is actually rising, which is a little bit of spoiler alert towards the end of the video, the tax receipts at the end will actually be greater, allowing the federal government to do more and more things and exert its power, right? Because, through the money, they can achieve power. So if they disincentivize this expensing, let's say you can't make these deductions anymore. Now, you can't deduct R&D. R&D would be an incredible, I hope they don't argue R&D. That would be absolutely, I don't know how you would justify that. Because again, R&D expenditure is still a tax. Like when you purchased equipment, when you purchase things, unless explicitly not taxed, it's typically taxed, right? In whatever jurisdiction you're in, right? And so already there, you're collecting the taxes. When you own property, you're going to be paying property taxes, unless there's explicit limitations or for whatever reason. But those are separate arguments. Maybe you should talk about those local jurisdictions not taxing them, and then you would argue to those people that should be taxed. But that's not this argument. You're arguing here a little bit that expenditure should not be taxed.
We want more manufacturing. We want higher paying jobs. We want more capital investment. And for each of these things, Congress has enacted a tax break that, at least on its face, is designed to encourage these things.
Take a tax credit for research and development as an example.
Oh gosh, they are.
R&D tax credit,
Oh
which
gosh.
allows companies to take deductions and credits for their spending on research, the things they spend money on to, make better hamburgers in the case of McDonald's.
Tool number 2, accelerated depreciation, another form of tax expenditure. We can also call these write-offs or expensing.
I already know what they're going to get wrong here. I already know it. Based on what they've done before, I know what they're going to get wrong
It's a
here.
key example of how those two different forms of accounting, book and taxable incomes, come into play.
Well, if you are a corporation that's really in manufacturing, really capital intensive, you may make a really large investment in a given year. Under financial accounting rules to determine your profits you're reporting to shareholders, you may have to deduct that over, say, 10 years, for example.
Oh no, I know what you're doing.
Under the general accepted accounting principles.
Don't do it.
For tax purposes, especially, you may be able to accelerate those deductions in the given year, and in some cases even taking a full and immediate deduction against your taxable income for that investment. What that means is you may be reporting a profit for financial accounting purposes, reporting no profit or even a loss for tax purposes. And that creates a difference between your financial income and your tax income.
Tool number...
You're not going to go into it? You're just going to leave it there? All right, well, I guess we'll get into it for the Capital Mindset viewers. But yes, okay, so here is a very basic understanding of book income, taxable income. Yes, there are actually different depreciation rules. Well, book income can have the same in some instances. As book income, there's greater variety. Tax income or tax accounting is more limited in terms of what you're able to do, depending on what it is you're looking at. Some might argue that tax accounting is going to be far more accurate in terms of its end result of income, right, regarding like how much you actually generated in terms of expenditure for taxes. So obviously, yes, the two are supposed to be reconciled. There's a reconciliation that occurs. But anyways, we're not getting into that. We're getting into these two bottom parts. So right here, I'm actually covering it. So you know what? I'm going to move myself towards the middle for temporarily. Oh, don't want to do that. Click on me, and let's put me right here. All right, so over here we have, or this side, this is book income. So book income, the important thing to note is, yes, the depreciation is different. You might depreciate it. Let's say we take their example exactly. We're going to depreciate this asset over 10 years. This one over here, we're going to depreciate it, let's say, immediately. Okay, what they're leaving out is what happens the following year. Can we depreciate this one again immediately? No. But we can depreciate this one again because we still have more to depreciate. We have 9 years left to depreciate. So what I actually, this gets into a lot of the things I say to you guys is that when we look at cash flows and GAAP net income, it's not that GAAP is like worthless or anything like that. Cash flows can be more indicative of how a company is doing depending on the company, but the cash flow statement and the income statement should fairly reflect one another over longer periods of time. Same thing goes here. Same exact thing goes here. This differences in depreciation should normalize over longer periods of time. An exhibit, you can't depreciate more, right, between these two. It's the timing of that depreciation, which is the distinction. So while you depreciate this one over 10 years and you depreciate this one over the course of, let's say, 1 year, then the very next year, you can't depreciate this one. It's done, right? Ignoring that you make any capital improvements and the like, because we're trying to keep it simple. Keeping it as simple as they kept it, just explaining it a little bit further. You can't depreciate this one anymore. So then what are they going to say? They don't go further than that because it's not convenient to their argument, right? This one right over here, you're done, right? The very next year, let's say you depreciate the full thing in 1 year. You expensed the asset. The very next year, you're done. This one allows you to depreciate it the next year again because we're, in this example, we're depreciating over 10 years. I don't know why. I can't understand why it is that they are leaving that part out unless they're trying to display an overall or a different perspective that's supposed to confuse you or make you upset because it, on its surface, because it's a surface level argument, it appears as though they're trying to, keep it that way so that it riles people up.
Purposes. And that creates a difference between your financial income and your tax income.
Tool number 3, stock options.
Okay.
There are tax
I know what you're going to
breaks
say
for
here
stock
already.
options, which allow companies to write off the cost, with air quotes around it, of the stock options they give their executives and other senior employees.
So that just comes down to the different rules between
Oh, I won't do that to you, my friend. Don't worry. I won't make your face like that. But this guy deserves it. Where's your face?
There are tax breaks for stock options, which allow companies to write off
I love this
cost with.
I love it. He just did that. He's one of those guys. He's one of those guys that believes stock options, stock dilution is just a cost. It's not a real cost, guys. No, as everyone here who watches this channel knows, it is a cost. You're paying for it, right? A corporation is an extension of you, the owner, right? If you buy Google stock, or let's say you buy Tattooed Chef, right? You buy Tattooed Chef, and you're the owner of Tattooed Chef. Tattooed Chef is a corporation, and you two are entities, but you own that entity, right? It's the same thing when we talk about dividends and why corporate income taxes, you still pay that, let's say you pay the full 21% at that point. All right, so you pay the full 21%, and then you are in the highest income tax bracket because you're a baller. And so you're going to pay a total of about 41%. So that's the real taxation. There is no tax break or tax, like you're not paying any taxes there. You're paying 41%, which is higher last time I checked than the top income tax bracket when you add those two together, because at the end of the day, that is your money. The money is just flowing through an entity that you own first, right? And so that entity, when that entity issues shares, it dilutes you. That's a cost to you, right? And you're the owner of that entity. You're the one who's, at the end of the day, kind of responsible for the taxation as an owner, right? You're not legally responsible. It handles it on its own. But I'm talking about on a bird's eye view. If you really think about it, it's your money, right? It's your money that's getting taxed, and it's also you that's getting diluted. That's an expense to you. So you should be able to deduct that through your entity that is diluting you, because it's a real expense. And this is one of those people, I guess. And remember his position in life. He has a high position, and whatever means he's right and infallible. He believes that stock-based compensation is not an expense. And by the way, I've seen other content from the same provider of content, CNBC, where they stated that, it's a way of avoiding taxation. And that's not even necessarily the case with stock-based compensation. Stock-based compensation, when I studied taxes or tax law, was interesting when I learned that taxation occurs when they can measure an increase in net worth necessarily. And like, for example, let's say hypothetically, even if you received your stock-based compensation, because let's say depending on your jurisdiction, because it's different in other parts of the world, what happens when you go to sell those stocks and actually realize the cash coming in? Well, then you're going to pay tax on that. You can only delay the inevitable, so to speak. All right, so in those jurisdictions. But in terms of actually receiving stock-based compensation, it's a way of the company not expending its cash, but it's still an expense. It's a form of using capital, okay? I guess it just flies over some people's heads. And again, if you're newer to the market, it's completely excused upon you to not understand that. It's completely excused. And that I want to be very clear. If you don't understand that, you're a newer person in the market, or you're not, someone who works in finance or accounting, you're excused. The issue is this individual has a position where supposedly he should know, and he's espousing these beliefs to a wider audience that CNBC targets that isn't in that field. And so this misinformation, unfortunately, will get passed around. And let's call it a difference of opinions. A difference of opinions with which I believe I've substantiated with good reasoning as to why, because again, I understand it is not a fact that it is a cost. It is a point of difference in terms of how we look at it, that it is a cost. And for example, I think if you try to evaluate an investment and you don't consider stock dilution, you will get an incorrect valuation number. Your valuation will not be as precise as it should be. So, how would that be if it wasn't a real cost?
Air quotes around it of the stock options they give their executives and other senior employees.
So that just comes down to the different rules between book accounting and tax accounting for when that compensation can be deducted. For book accounting, it's deducted immediately. For tax purposes, and maybe at a later date when it's ultimately vested to the employee, and that creates a discrepancy in the total amount of taxable income that these firms are reporting.
They write them off as if they were actual cash expense, when of course giving stock options to your employees It's absolutely not the same sort of out-of-pocket expense.
Okay, now I'm very confused because now they're stating the differences, because let me repeat what they said. They said in book accounting, you can expense it immediately. Tax accounting, you can expense it when it actually is vested by the employee. When they were just talking about in the depreciation example was the opposite. But then you see they're I don't know who edited this video together, but your two speakers you're not mixing well with one another, because then the next guy comes in and just says nothing regarding that, and then just talks about it not being cash and for whatever reason. So you have to pick one and kind of keep the linear thought process. Otherwise, I mean, I'm catching it now and I'm kind of highlighting it, but most people probably will just watch that and not kind of catch on to that. But again, this guy's still ranting about how it's not an expense, and it's kind of cringe. That's very cringe. And you know why it's pretty cringe is because of supposedly the authority that you're supposed to have, and yet you hold such an opinion, which I think is, I mean, I don't know. My opinion is that your opinion is rubbish, but you know, that's just an opinion. And the audience here, you guys will think for yourselves and decide whether or not that guy's opinion is rubbish or whatever.
Right, signing a check every 2 weeks.
And finally, perhaps
it's because the shareholder pays it. The shareholder pays it. The shareholder pays it. Okay, and the shareholder is the owner of the company.
Murkiest of all tools, tool number 4, offshoring.
There is a very deliberate, at the moment, lower rate for foreign profits of US multinationals, and something between 0 to 10.5 on their foreign profits. And that's an outright tax benefit for them that's worth roughly $60 billion a year, according to the joint.
Well, okay, if we're saying it's 60 billion, that's absolutely chump change for the federal government. That's not going to fix anyone's problems. So already there, I know they're going to be a little bit like hilarious about this, because they're probably going to talk about really small little examples, because 60 billion a year in totality is going to be absolutely hilarious. So regardless, this whole section is probably going to be about foreign politics, and I'm not going to have really an opinion on that, because if anything, it's just going to be opinionated. What I'll say is that countries should figure it out. The thing is that countries inherently want to be competitive against one another. So yeah, whatever arguments they're going to make here, I'm going to have no opinion for or against it. I'm just going to be like, okay, whatever, yeah, sure. Whatever you say. It's countries at the end of the day, they're going to negotiate with one another on whatever rules they want to engage with. But it is interesting that the United States wishes to kind of exert itself in that capacity and try to make sure that other countries cannot compete against them. I mean, as the United States probably obviously would want, but I don't know if the other countries are just going to allow it, right? So, you know, that's the only commentary I can really have on that.
Joint Committee on Taxation, but it also creates this incentive to shift their worldwide profits into that sort of foreign low tax bucket.
U.S.-based corporations are
I swear they're going to use a
shift
crazy example.
Income into tax haven. They talk about the Cayman Islands, about Bermuda,
Cayman Islands,
Ireland, and Luxembourg, and the Netherlands to some extent.
There are estimates that sort of shifting is in the tens of billions of dollars a year, up to $100 billion a year.
Here's an example. Whirlpool, a U.S. company known for manufacturing home appliances both in the U.S. and Mexico.
Whirlpool tried to avoid both US and Mexican taxes on the profits from its Mexican operations. And it did that by having the Mexican operation owned by a Mexican company with no employees, and then having that Mexican company owned by a Luxembourg holding company that had one employee. And then it tried to claim that due to the combination of the US, Mexico, and Luxembourg tax rules, the millions of dollars of its profits from the Mexican operations wouldn't be subject to tax in Luxembourg, wouldn't be subject to tax in Mexico, and wouldn't be subject to tax in the US. So it was trying to sort of take advantage of the disconnect between all of those tax systems to avoid tax in all of those countries. And of course, said, no, that goes too far. That's not what the law is.
Okay, I was literally joking, but apparently they are doing that. So good job for pointing out perhaps what was, I mean, like, how big is Whirlpool? I pause the video and kind of get an idea of how big Whirlpool is. How much money does Whirlpool make a year? They are basically stating that it is a huge, this was probably like a little project from Whirlpool, some sort of inside project that they were trying to, you know, play around a little bit with the rules, and they failed. But they almost made it sound at the beginning of this example that it was like all of Whirlpool's operations and like like at least being half of Whirlpool's operations. I don't know. You're telling me that it was like a $50 million like thing. As soon as you said in the millions, I was just like, we're talking about Whirlpool. We're talking about like billions of dollars in terms of valuation, huge business. 50 mil is what they were really fighting for. So this is some sort of like this is a small part of their business. It's not insignificant, but I mean, that's your example. Why didn't you guys go for like a bigger fish that would be more impactful? That implies that you couldn't really find one. I mean, you could have at least like probably, I don't know, used Apple. Apple was probably a better one that they did the whole shenanigans they were doing in Ireland. Why would you use Whirlpool? This is like, I mean, maybe to a lot of people, 50 million will sound like it's like a lot, but I mean, you already were talking about that the totality of this situation was, just in the tens of billions, which to the federal government's like nothing. But yeah, I don't know.
Or actually allows.
Whirlpool told CNBC that it follows all tax laws in the jurisdictions in which it operates, and that Whirlpool's use of the tax code
all right, whatever.
actually
Of course they're going to say that.
Whirlpool should have
to shift their intangible assets out of the U.S. to avoid taxes. And it should be a top priority of policymakers right now to prevent them from doing so.
Look, I don't really trust you, my friend. But whatever. Yeah, I have no opinion against you in that argument. Isolating your arguments apart, because that's just international politics. I'm not going to comment on that.
Accounting and tax experts say that probably the first best way to fix the problem is to go to the tax rules and look at each of the different provisions and decide whether or not you want that in the tax code, repeal those inefficient tax breaks or reduce them. Some say that...
Oh, yeah. I love this argument. The argument that, the ones who created the tax breaks in the first place that you disagree with are going to be the same ones that are going to fix them. Big brain.
It is unrealistic, otherwise it would have happened anyway.
Okay, she's fair, unrealistic, but I don't know if you believe that. I think you're just quoting other people.
And it's a hard thing to do.
One solution could be to beef up the IRS.
Beef up the IRS.
There is nothing the IRS does that is more cost intensive, that requires more resources than investigating the tax avoiding behavior of large multinationals.
Between 2011 and...
They are? Okay. That's pretty cringe because he actually just used the word incorrectly. Tax avoidance behavior. The IRS mainly The IRS wants to find the people who are tax evading. Tax evasion is illegal. That's pretty cringe that you used the vocab term incorrectly. You're supposed to be some sort of subject matter expert that they invited on, and you just misused the two words. Okay, so legally speaking, for everyone to understand, there's two words, and they used it correctly. I didn't highlight it in the beginning, and they actually use it correctly in the title. Avoid taxes. Avoidance. You avoid the scenario, the situation that incurs a tax liability. Avoidance is legal. Evasion is illegal. Okay, let me be clear on that. And so this individual had just used the term avoidance as though the IRS investigates for avoidance instead of evasion. The IRS may sometimes make judgments on if the avoidance is legitimate or not, but they don't expense a ton of time going after people in terms of like arresting them for avoidance. They go after evasion. Evasion is the illegal act, and that's what they really go after, and that's what the Congress wants to go for, not avoidance, evasion. Oh, yeah,
2019, the IRS's budget for enforcement was cut by about a third.
One policy solution would be to implement minimum corporate taxes, both an international minimum tax and a domestic minimum tax.
That global minimum tax would end the race to the bottom in corporate taxation.
The legislation that's been debated by Congress would raise the U.S. minimum tax rate on foreign profits from 10.5% to 15%. Implementing an international minimum tax would help tamp down on some of the offshoring of profits that companies can maneuver about.
Where that country doesn't impose at least a 15% rate of tax, then the US will impose an additional tax so that the corporation pays at least 15% in each country.
Again, I have no opinion on this matter at all. I apologize, because that's just international politics. My only comment, the only comment, is that it'd be interesting to see how all the other countries take it, because essentially what the United States is doing is saying, nah, you can't be competitive against us. Here you go. So for my European audience, let me know if you guys would actually like that, because the implications would be that we're basically enforcing that, the money still kind of just doesn't flow to you as much as possible. And so from the American perspective, yeah, well, that's, all well and good. The international perspective might be counter to that. I'm very interested to hear your comments down below. If you don't live in the United States, what are your opinions on that? Maybe you do agree with that because, the mentality of, and I'm not saying it's, I criticizing you for having that mentality, but maybe, yeah, screw the corporations, blah, 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 blah. Yeah, maybe, I don't know, but let me know kind of your perspective. I'd love to read it. So as long as you want to make the comment, make it, I'll read the whole thing. The more perspective, the better. And I really am always interested in hearing the different perspectives of people. So very interested to see if anyone does provide that. But yeah, let me know down below. Would you like the United States to kind of basically dictate your tax levels and basically remove the incentives to have said business in your country? If you're from Ireland, that's basically targeted against you. Or I think a lot of European countries have lower tax rates, corporate tax rates, than the United States, or at least did. And United States, by kind of elevating that, let me be very clear, this one, the 15%, is very much targeting the Irish. But yeah.
And that would raise about $350 billion over 10 years. Then
there's domestic profits.
350 billion over 10 years. What the heck? Wasn't the proposal to increase the budget by like 90 billion to the IRS every year? So 350 billion over 10 years. What kind of big brain logic is that?
One major proposal that's come out of the last year and advocated by both Biden administration and members of Congress has been to levy a minimum tax on book income directly.
Implementing a domestic corporate minimum tax of 15% could reduce the gap between the book income and taxable income. Basically,
why have tax accounting at all? Just eliminate it. I'm so confused. What? Okay. A 15% minimum. Why not just put a 15% minimum tax in the IRS code? That's so stupid. It makes no sense. Okay. There's two. Again, like from the beginning of the video, there's two forms of taxation. Like, okay, not taxation. Sorry, accounting. And so you have tax accounting, which is supposed to dictate how much tax you pay, and then there's book accounting, which is supposed to be GAAP, and it's not even official government organization. It's what we use in order to kind of set the standards for how companies should report things, and it's a good metric to. It's supposed to be designed by accountants, people in the professional field. If you're going to levy taxes on the booking, that makes no sense. Just if you want to do that, why don't you just put whatever?
Be cutting down the value of some tax expenditures.
The first priority with corporate tax reform should be to get it to lift its own weight, to pay for companies to pay by whatever means something closer to the statutory rate, and the book income tax would certainly accomplish that. I think there are better ways of doing it. I think there are more all-inclusive ways of doing a minimum tax, but it's certainly better than nothing.
Oh gosh, okay, we're finally done with that. Oh my gosh, no, there's another one. It's begging for me. No, maybe too long of a video, but it's begging for that click. I'm almost enjoying it. I guarantee you that one's about taking debt on your assets and blah, 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 blah. Yeah. That one would be probably more interesting than this one. This one was just gotta be honest, that one dude, the woman wasn't too bad, The dude was terrible, whatever his name is. Not the younger dude, the older dude. The older dude was just, oh my gosh, just like, ugh. All right, so I guess we'll kind of get into the thing that I was hinting at the beginning of this video. So at the beginning of this video, I did say I was going to show you guys a phenomena. I'd welcome everyone to kind of look into it further, but it's something I did actually take a look at in my college days. So taking a look at what we have here, just to remind everyone, GDP is calculated by consumption plus investment plus government spending plus the delta of exports and imports. Okay, so that is there on the side for you guys to remember this. Taking a look at and explaining a little bit further what it is that we're looking at here. And let me actually zoom in for those of you who are watching on the phone. So we have outlays of the government. This is government expenditure. Not really important for what we're looking at here, but receipts of GDP is more important. This is the income of the government recorded every year as a percent of GDP. You can kind of see here it's been fairly steady. It's range bound. And that's the interesting part. Actually, when you this data is difficult to find on your own, but universities have very good sources of data. If you actually ask an economics professor at your local university, if you are a college student, I actually welcome that you go do that and try to find the same exact statistics recorded on other countries such as Italy, Spain. What you'll find is that they're all very different, and United States is fairly good. Like, this is very good. This is a very good range to be in. Other countries have it worse off in terms of how much they're capable of collecting in terms of percent of GDP. The reason I can't really tell you. We can probably round it around to culture. So in Italy, for example, anecdotally, there is a culture of tax evasion. I have Italian family, just so it's no prejudice or anything. But they have a culture of tax evasion. My wife is Brazilian. Her family's told me the very similar things about Brazil. Brazil has a culture of tax evasion. And you see I'm using the word properly. Evasion, not avoidance. I'm looking at you, guy from CNBC. So evasion, which is the illegal form of not paying your taxes. Italy, it got so bad at one point that they actually implemented a policy where the police would stop people with nice cars. And they would ask to see your tax returns because it got really bad. Okay, so as a percentage, United States is fairly good. That is probably indicative that the American people tend to have a respect for the rules as it comes to taxes. We're just isolating it in taxes. And from there, we can kind of also outlay, when we overlay these statistics of tax percentage, we actually see that regardless of the tax rates, up or down, the percentage of GDP is more or less the same. And then barring World War II, which World War II was a bad time for the U.S. government to collect taxes, more further evidence that perhaps war or a big world war like that, where we're expensing so many resources towards a war, is perhaps not that good. All right, so, and kind of an isolation of the policies that were around there. You can kind of see during that same time period the outlay of government spending as we entered the war. So we spent a lot of money, but then we collected very little money as a percent of GDP throughout that war. And then we kind of just started there. So we see that better exemplified here. So this is, I think, when we entered the war, peak war, and then we kind of just went through our daily lives. We kind of came down. But we were pretty range bound, and the average is about 16.87. You'll hear me quote that a lot. So 16.87, and I think the highest the highest we've ever achieved, it was about, what was it, like 20 point something. But what this basically implies is that it doesn't really matter what the tax rate, tax policy is. It's actually very interesting because it actually does go back to not the policies, but the not teachings, the discoveries of James Laffer in the 1970s with the Laffer curve. So what that basically implies is that there's kind of a sweet spot towards taxation, and the government should actually prefer or try to improve growth in GDP in order to actually improve receipts, because receipts is more of a function of GDP, which makes sense. If you really break that down, it says, okay, the amount of money the government collects is a function of the size of the government's, not the government's, but the country's economy. That makes a lot of sense. And then when you break it down, all the things that they did miss out on in that video, but they did mention at the very beginning, I just want to highlight, because if I asked anyone, they'd be like, well, we did say it in the beginning of the video, they pay many other forms of taxation, and their actions throughout the economy have a trickle effect throughout the said economy, and all of that is taxed, right? So then, therefore, it's not that important to consider the actual tax rate per se. What matters more is the economic productivity that their actions, bring forth. And just kind of like a bird's eye view understanding of this, a company is incentivized to use its resources efficiently, while government is not. So when you tax, right, let's say you're making $100,000. When you go out and you spend your $100,000, you are ideally spending it in things that you desire. You are exerting your demand into the economy, and you're telling the economy what it is that you want. And then collectively, people exert their demand and they kind of speak with their money. They say, this is what we desire. And, people used to say, for example, companies don't care about green initiatives or whatever. And then you see that consumers, began to supposedly care about green initiatives. And then you immediately see companies shift themselves to like green initiatives. It's a rule of life in a capitalist society that the consumer has all the power. As long as you control your capital, right, your money, and you decide where it goes, you basically dictate where all these companies will go, right? They just want, to satisfy you in every sense of the word, the customer. So regardless, as long as you're doing that, you're basically voting with your dollars in terms of the actions you take place. So if I say, let's say I take away half of your income, and then I go out and spend it on some random thing that maybe no one wants, right? We can cause market distortions, right? Because I'm going out and taking $50,000 of your money, and I'm going to go spend it on, I don't know, some random thing. Ideally, philosophically, everyone thinks the government should be spending it on things that everyone needs collectively, like let's say infrastructure or something like that. But in practice, it doesn't really work out that way. So this is actually research done by Dr. Lacey Hunt that shows government spending and government debt is actually a negative drag to economic growth on the economy, because essentially what it implies is it's taking money out of the private sector, which is private sector debt is a net positive factor on the growth of an economy, but government debt, government spending is typically a net negative factor growth on the economy because of the unperceived consequence of malinvestment, which we're getting into like the crux of it. This is kind of like the macro part of the video, but malinvestment is very difficult to measure. It's something we don't see in the immediate. It's something everyone in every time period has always underestimated. If you read history, economic history, people in their time always underestimate malinvestment or the consequences of malinvestment. So for example, if you are a person you hear someone say, well, it doesn't matter because the government can just get more money and then spend it more on these projects. It doesn't matter that it's wasteful. They're not understanding the consequences of malinvestment, the consequences of misuse of resources, and how that might trickle and have like this butterfly effect in other parts of the economy. Unforeseen consequences. And you don't see these consequences until they just, blow up in your face, right? Malinvestment occurs, for example, in the 2008 financial crisis, because if we really get down to it, the beginnings of this financial crisis began in 1996 from legislation that was passed back then. And people at that time had no perceived notion of how this would trickle into the future. And quite literally, almost 10 years later, because humans have short lives, so we don't, it's hard for us to kind of perceive consequences in these time frames because, for us, our lives, we live like 80 years. So sometimes these consequences take decades sometimes to pan out. And I think some of you might actually appreciate that way of thinking about things because, yes, you might be right about the consequences, but it might take a long time for those consequences to manifest. That doesn't mean you're wrong. It just means a lot of people won't see it, right? They won't understand it. They won't perceive it. They won't see it. So similar with government spending, that is the case. And then when you kind of overlay this phenomena, because it's a phenomena, it's not a theory, it's nothing like that. It's a phenomenon, which means it's an observed reality that we can see, and we can have theories as to how we got there. And by the way, you can overlay all the types of taxations here, and it's more or less the same. It doesn't matter. It doesn't care. It's more about that GDP. That GDP actually is what's very important. It averages out, and it's kind of range bound. All right. You can have more inefficient time periods, and actually, you can see there between 2006, 2009. You see that downdraft. So bad economic times is usually bad as a percentage of GDP in terms of tax collection. And so when you have good economic booms, vice versa, you have good moments, right? And I think there was forms of actually tax cuts, as you can see here, during this time period. And you see actually throughout that time period, you actually saw an increase in terms of percent of GDP. Because again, it's not necessarily the point. The point isn't the tax rate. The point is how much movement occurs in that economy and how big can that economy get. The largeness of the economy will be a function of nominal amounts, but as a percent, which is the actual important factor, we can see that tax rates aren't actually a contributing factor. There's more likely different things contributing to that. So even then, kind of on another discussion, you can see how government spending is actually a factor of GDP. When you get down to that, it's quite interesting, because when you start to understand that the actual tax receipts is a function of GDP, you can understand why austerity is a actual very place to be. Because if you're forced to do austerity measures, well, guess what? You're reducing the government spending portion. And if your tax receipts are a portion or a function of GDP, if you are pursuing actions that reduce GDP, will you reduce the nominal amount of your tax receipts? which is bad, because you're enforcing austerity measures because you're in a pickle. So it actually means that once you're at that stage, you're kind of in a very difficult to get out of death trap, what we call a death spiral. So kind of explaining multiple things in one video there, but if you've heard those words before, that's basically why this phenomena helps explain why those things occur. Why does a debt trap, death spiral occur? Well, because if you think about it, tax receipts are a function of GDP. GDP is a function of all these factors here, and one of them is government spending. So, and I'll actually move over here so you guys can actually see that. Government spending right there, and represented by the G in the simple formula up top. But when you do that and you're supposed to be trying to get your budget in order, well, then your income actually will go down. So anyways, I hope you guys enjoyed this video. If you guys did enjoy the video, go ahead and feel free to leave a like, comment down below. I'd love to hear your thoughts on the different questions I provided. Just so everyone knows, I forgot to mention this in the beginning of the video, but that Discord community, once you go into the Discord community, it will actually prompt you to actually answer some questions. It's supposed to be a filter of sorts to kind of not allow bots in, again, to protect the community from spam. And the like. So yes, it's fairly simple questions. It's also for me to read and get to know you a little bit. But other than that, thank you guys so much for watching. I'll see you guys in the next one. Bye.